Question 1. An applicant for a life insurance policy in North Carolina intentionally fails to disclose a pre-existing heart condition on the application. The policy is issued, and 2 years later, the insured dies due to complications from that heart condition. What action will the insurer likely take? A. Pay the full death benefit as the contestability period has passed. B. Pay a reduced death benefit equal to the premiums paid. C. Deny the claim due to the material misrepresentation. D. Deny the claim because the policy is void from inception. Answer: A. Pay the full death benefit as the contestability period has passed. The incontestability clause states that after a policy has been in force for a specific period, typically 2 years in North Carolina, the insurer cannot dispute the validity of the policy or deny a claim based on misstatements in the application, even if they were material, as long as there was no fraud. Since 2 years had passed before the insured's death, the insurer is obligated to pay the full death benefit. This clause protects policyholders from having their coverage challenged years after it was issued, making the policy effectively incontestable after the period. Always remember this clause provides stability for policyholders after the initial scrutiny. Question 2. Which of the following statements is true regarding the insurable interest requirement in North Carolina life insurance? A. Insurable interest must exist only at the time of the insured's death. B. Insurable interest must exist at the time the policy is issued, but not necessarily at the time of death. C. Insurable interest is not required if the policy owner is also the insured. D. Insurable interest is only required for policies with a cash value component. Answer: B. Insurable interest must exist at the time the policy is issued, but not necessarily at the time of death. For a life insurance policy to be valid, insurable interest must be present at the inception of the contract, meaning at the time the policy is applied for and issued. This ensures that the policy owner has a legitimate financial or emotional stake in the continued life of the insured, preventing the use of life insurance for speculative or wagering purposes. For example, a spouse has an insurable interest in their partner, and an employer has an insurable interest in a key employee. The principle ensures that life insurance acts as protection against loss, not a gamble. Question 3. All of the following are typically characteristics of a universal life insurance policy except: A. A flexible premium schedule. B. An adjustable death benefit. C. A guaranteed interest rate on the cash value. D. A transparent expense and mortality charge structure. Answer: C. A guaranteed interest rate on the cash value. Universal life insurance policies are known for their flexibility, allowing policyholders to adjust premium payments and death benefits within certain limits. While they build cash value that earns interest, the interest rate is typically not guaranteed but rather adjusted periodically based on current market conditions, often with a minimum guaranteed rate that is very low. This contrasts with traditional whole life, which has a guaranteed cash value growth rate. Remember that universal life offers transparency by separately showing the cost of insurance, expenses, and cash value accumulation, but not a guaranteed high interest rate. Question 4. A policy owner in North Carolina allows their life insurance policy to lapse due to non-payment of premiums. They wish to reinstate the policy. All of the following are conditions for reinstatement except: A. The policy owner must provide evidence of insurability. B. All overdue premiums plus interest must be paid. C. The policy must not have been surrendered for its cash value. D. Reinstatement must occur within 10 years of the lapse date. Answer: D. Reinstatement must occur within 10 years of the lapse date. The reinstatement provision allows a lapsed policy to be restored, typically requiring the policy owner to submit a new application with evidence of insurability, pay all back premiums plus interest, and repay any outstanding policy loans with interest. While specific timeframes vary by policy and state, reinstatement usually must occur within a limited period, often 3 or 5 years, not 10 years. This provision offers a way for policyholders to regain their coverage without applying for an entirely new policy, provided they meet the conditions within the specified timeframe. Always check the specific policy's terms for the exact reinstatement period. Question 5. In North Carolina, an agent tells a prospective client that a life insurance policy offered by a competitor is financially unsound and that the competitor's agents are poorly trained. This statement is an example of A. Twisting, B. Rebating, C. Defamation, D. Misrepresentation. Answer: C. Defamation. Defamation occurs when an agent makes false or malicious statements about a competing insurer's financial condition, its agents, or policies with the intent to injure their reputation. The agent's claim that the competitor's policy is financially unsound, and its agents are poorly trained, directly targets the competitor's integrity and is a clear example of this illegal trade practice. This is distinct from misrepresentation, which involves false statements about one's own policy, or twisting, which involves inducing a policyholder to lapse an existing policy to purchase a new one. Remember, disparaging competitors unfairly is always a regulatory violation. Question 6. What is the primary purpose of the grace period in a North Carolina life insurance policy? A. To allow the insurer additional time to underwrite the policy. B. To prevent the policy from lapsing immediately due to an unintentional missed premium payment. C. To provide the policy owner with an extra period to review the policy terms. D. To allow the insured to change beneficiaries without penalty. Answer: B. To prevent the policy from lapsing immediately due to an unintentional missed premium payment. The grace period is a specific period, typically 30 or 31 days in North Carolina life insurance policies, following the premium due date during which the policy remains in force even if the premium is not paid. Its primary purpose is to protect the policy owner from inadvertently losing coverage if a payment is slightly delayed, allowing time to make the payment without the policy lapsing. If the insured dies during this period, the death benefit is usually paid, minus any overdue premium. This provision is a critical consumer protection feature ensuring continuity of coverage. Question 7. A beneficiary designation that states, "to my children," per stirpes, means that if one of the children predeceases the insured, that child's share of the death benefit will go to A. The surviving children equally. B. The insured's estate. C. The deceased child's heirs. D. The insurer, as unclaimed property. Answer: C. The deceased child's heirs. The per stirpes, by the root or by branch, beneficiary designation means that if a named beneficiary dies before the insured, that deceased beneficiary's share will be distributed to their living descendants. For example, if the insured has 3 children and one child dies before the insured, that deceased child's portion would then pass to their own children, the insured's grandchildren. This method ensures that the family line of the deceased beneficiary continues to receive the intended share, unlike per capita, which would distribute the share only among the surviving named beneficiaries. This designation helps ensure the policy owner's intentions for generational distribution are met. Question 8. Under a non-forfeiture option, which of the following allows a policy owner to use the policy's cash value to purchase a new whole life policy with a reduced face amount? A. Cash surrender value. B. Extended term option. C. Reduced paid-up option. D. Automatic premium loan. Answer: C. Reduced paid-up option. The reduced paid-up option is a non-forfeiture option that allows the policy owner to use the existing cash value of a permanent life insurance policy to purchase a fully paid-up new whole life policy with a smaller face amount than the original policy. No further premiums are required, and the new policy continues to build cash value and pay dividends, if applicable. This is a good choice for someone who wants to maintain lifetime coverage but can no longer afford the original premiums. It offers continued, albeit reduced, lifetime protection without additional cost. Question 9. An individual licensed as a life insurance agent in North Carolina must notify the Commissioner of Insurance of a change in their residential address within how many days? A. 10 days. B. 15 days. C. 30 days. D. 60 days. Answer: C. 30 days. In North Carolina, licensed insurance producers are required to notify the Commissioner of Insurance of any change in their residential or business address within 30 days of the change. This regulation ensures that the Department of Insurance can maintain accurate contact information for all licensed agents, which is crucial for communication regarding license renewals, regulatory updates, and compliance matters. Failing to provide timely notification can result in fines or other disciplinary actions. Prompt notification is a fundamental responsibility of maintaining an active license. Question 10. A policy owner purchases a $250,000 whole life policy and includes a waiver of premium rider. If the policy owner becomes totally disabled, what benefit does this rider provide? A. A lump sum payment equal to the policy's cash value. B. The insurer will pay the policy premiums during the period of disability. C. The policy will automatically convert to a term policy for the duration of the disability. D. The policy's death benefit will be doubled if the disability results in death. Answer: B. The insurer will pay the policy premiums during the period of disability. The waiver of premium rider is a valuable benefit in a life insurance policy that ensures coverage continues if the policy owner becomes totally and permanently disabled. If the policy owner meets the definition of total disability set forth in the rider, the insurer will pay all future premiums for the duration of the disability, keeping the policy in force and allowing its cash value to continue growing. This rider acts as a safeguard, preventing a policy from lapsing due to an inability to pay premiums during a difficult financial time caused by disability. It's a key protection against unforeseen circumstances. Question 11. Which of the following statements about a variable life insurance policy is most accurate? A. Its cash value growth is tied to a fixed interest rate declared by the insurer. B. It offers a guaranteed minimum death benefit. C. The policy owner bears the investment risk of the separate account. D. It does not require a securities license to sell. Answer: C. The policy owner bears the investment risk of the separate account. Variable life insurance policies are unique because their cash value is invested in a separate account, which contains sub-accounts similar to mutual funds, and the policy owner directs the investment choices. This means the policy owner bears the investment risk, as the cash value and potentially the death benefit can fluctuate based on the performance of these underlying investments. Because of this investment component, agents selling variable life products must hold both a state life insurance license and a FINRA securities license. This structure contrasts sharply with traditional whole life, where the insurer guarantees the cash value growth and bears the investment risk. Question 12. A North Carolina agent is explaining the free look provision to a new client. Which of the following is an accurate statement about this provision for life insurance policies? A. The free look period is 5 days and allows the policy owner to cancel for any reason. B. The free look period is 10 days, or 30 days for replacement policies, and begins when the policy is delivered. C. The free look period is 20 days and only applies if the policy has a cash value. D. The free look period is 31 days and applies only to group life policies. Answer: B. The free look period is 10 days, or 30 days for replacement policies, and begins when the policy is delivered. In North Carolina, the free look provision for individual life insurance policies is typically 10 days from the date of policy delivery. However, for replacement policies, where an existing policy is replaced by a new one, the free look period is extended to 30 days. This period allows the policy owner to review the policy terms and conditions. If they decide to cancel during this time, they receive a full refund of all premiums paid. This essential consumer protection ensures buyers have adequate time to confirm the policy meets their needs after receiving the official contract. Question 13. Which action by a life insurance agent in North Carolina would be considered twisting? A. Offering a prospective client a portion of the commission as an inducement to buy a policy. B. Making a misleading statement about the terms of a policy being sold. C. Inducing a policy owner to lapse or surrender an existing policy for a new one, to the policy owner's detriment. D. Presenting an incomplete comparison of two different life insurance policies. Answer: C. Inducing a policy owner to lapse or surrender an existing policy for a new one, to the policy owner's detriment. Twisting is an illegal unfair trade practice where an agent persuades a policy owner to drop an existing policy and purchase a new one, often implying the new policy is somehow superior, even if it is not in the policy owner's best interest. This can result in the loss of favorable policy provisions, the start of a new contestability or suicide period, and new acquisition costs. The key element is inducing the policy owner to exchange policies to their disadvantage. It is considered a serious ethical and legal violation. Question 14. An insured dies during the grace period of their life insurance policy without having paid the premium. What will the insurer most likely do? A. Deny the claim because the premium was unpaid. B. Pay the full death benefit. C. Pay the death benefit less the unpaid premium. D. Pay the cash value of the policy. Answer: C. Pay the death benefit less the unpaid premium. The grace period allows a life insurance policy to remain in force for a specific period, typically 30 or 31 days in North Carolina, even if the premium is not paid by the due date. If the insured dies during this grace period, the policy is still active, and the death benefit will be paid to the beneficiary. However, the insurer will deduct any unpaid premium from the death benefit amount before paying it out. This provision ensures the policyholder has continuous coverage while also allowing the insurer to collect any outstanding payments. Question 15. The Medical Information Bureau, MIB, is used by life insurers primarily to A. Prescribe medications for applicants with pre-existing conditions. B. Exchange information about an applicant's health history to prevent fraud and misrepresentation. C. Conduct medical examinations for all insurance applicants. D. Provide treatment recommendations for complex medical cases. Answer: B. Exchange information about an applicant's health history to prevent fraud and misrepresentation. The Medical Information Bureau, MIB, is a non-profit trade organization that maintains a database of confidential medical information on applicants for life and health insurance. Insurers report medical conditions or other significant health information they discover during the underwriting process to the MIB, and they can query the MIB to identify any inconsistencies or omissions in new applications. This system helps prevent fraud, misrepresentation, and ensures that all insurers have access to consistent, relevant health data for risk assessment. It acts as a flag system, not a diagnostic or treatment provider. Question 16. What is the primary characteristic that distinguishes a limited pay whole life policy from an ordinary whole life policy? A. Limited pay policies have a higher guaranteed interest rate on cash value. B. Premiums for limited pay policies are paid for a shorter, specified period, but coverage lasts for life. C. Limited pay policies offer a flexible premium schedule, similar to universal life. D. The death benefit of a limited pay policy decreases over time. Answer: B. Premiums for limited pay policies are paid for a shorter, specified period, but coverage lasts for life. Limited pay whole life insurance is a type of permanent life insurance where premiums are paid only for a specified period, such as 20 years or until age 65, after which no further premiums are due, but the policy remains in force for the insured's entire life. In contrast, ordinary whole life policies require premiums to be paid throughout the insured's entire life until age 100 or death. The shorter payment period for limited pay policies results in higher annual premiums but offers the convenience of becoming paid up sooner. Both provide lifelong coverage with a guaranteed death benefit and cash value growth. Question 17. The North Carolina Commissioner of Insurance has the authority to do all of the following except: A. Conduct examinations of insurers and agents. B. Create insurance laws and statutes. C. Issue, suspend, or revoke insurance licenses. D. Impose penalties for violations of the insurance code. Answer: B. Create insurance laws and statutes. The North Carolina Commissioner of Insurance is the chief officer responsible for regulating the insurance industry within the state. While the Commissioner has broad powers to enforce existing insurance laws, investigate unfair practices, issue licenses, and impose penalties, they do not have the authority to create or enact new insurance laws, statutes. That power rests solely with the state legislature. The Commissioner's role is to administer and enforce the laws as written by the legislature, not to write them. Question 18. A policy owner has a life insurance policy and wants to assign their rights in the policy to a bank as collateral for a loan. This type of assignment is known as A. Absolute assignment. B. Collateral assignment. C. Viatical assignment. D. Revocable assignment. Answer: B. Collateral assignment. A collateral assignment of a life insurance policy is a partial and temporary transfer of ownership rights, typically used to secure a loan or other debt. The policy owner retains most rights, but the assignee, example a bank, has a claim to the death benefit up to the amount of the outstanding loan balance if the insured dies. Once the loan is repaid, the assignment is terminated, and full ownership rights revert to the policy owner. This differs from an absolute assignment, which is a complete and permanent transfer of all policy ownership rights. Question 19. Under what circumstance would the suicide clause in a life insurance policy not typically apply in North Carolina? A. The insured commits suicide 18 months after the policy's issue date. B. The insured commits suicide 3 years after the policy's issue date. C. The insured commits suicide while legally insane within the first year. D. The suicide occurs during the policy's grace period. Answer: B. The insured commits suicide 3 years after the policy's issue date. Most life insurance policies, including those in North Carolina, contain a suicide clause that states if the insured commits suicide within a specific period, typically 2 years, from the policy's issue date, the insurer's liability is limited to a refund of premiums paid. If suicide occurs after this 2-year period, the full death benefit will be paid. Therefore, if the insured commits suicide 3 years after the policy's issue date, the suicide clause would not apply, and the full death benefit would be paid. This clause is designed to prevent people from purchasing life insurance with the intent to commit suicide for financial gain. Question 20. Which life insurance rider provides for an increase in the death benefit if the cost of living increases, based on the Consumer Price Index, CPI? A. Guaranteed insurability rider. B. Waiver of premium rider. C. Cost of living rider, COL. D. Accidental death benefit rider. Answer: C. Cost of living rider, COL. The cost of living, COL, rider is designed to help maintain the purchasing power of the death benefit in the face of inflation. This rider allows the policy's death benefit to automatically increase each year, without requiring evidence of insurability, based on a rise in the Consumer Price Index, CPI. While the death benefit increases, so do the premiums to cover the additional coverage. This rider helps ensure that the payout to beneficiaries keeps pace with inflationary changes over time. Question 21. A policy owner in North Carolina decides to surrender their whole life policy for its cash value. When will the cash value be taxable as ordinary income? A. Only if the policy was issued within the last 5 years. B. When the amount received exceeds the premiums paid into the policy. C. When the policy's cash value exceeds its face amount. D. Cash value is never taxable as ordinary income. Answer: B. When the amount received exceeds the premiums paid into the policy. When a life insurance policy is surrendered for its cash value, the portion of the payout that represents a gain over the premiums paid, the cost basis, is taxable as ordinary income. The premiums paid into the policy are considered the policy owner's cost basis. Any amount received above this cost basis is considered taxable gain. For example, if $10,000 in premiums were paid and the cash value received is $12,000, then $2,000 would be taxable income. This interest-first rule means the IRS assumes the first money withdrawn is interest. Question 22. In North Carolina, what is true regarding a life insurance policy's delivery to the applicant? A. The policy is considered delivered when the applicant signs the application. B. Delivery occurs when the agent receives the policy from the insurer. C. Actual delivery to the applicant, and often the collection of the initial premium and signing of a statement of good health, is required for coverage to be in force. D. Delivery is not important, as coverage is effective from the date of application. Answer: C. Actual delivery to the applicant, and often the collection of the initial premium and signing of a statement of good health, is required for coverage to be in force. For life insurance policies, delivery is a crucial step in the policy's effective date, especially if the initial premium was not paid with the application. If the applicant paid no premium at the time of application, coverage usually does not begin until the policy is physically delivered to the applicant, the first premium is collected, and often a statement of good health is signed, confirming the applicant's health hasn't changed since the application date. This process ensures both parties acknowledge the policy is in force and the conditions for coverage have been met. Question 23. A consumer in North Carolina is seeking a life insurance policy that offers a guaranteed death benefit, guaranteed cash value growth, and premiums payable until age 100 or prior death. Which type of policy best fits this description? A. Term life. B. Universal life. C. Variable life. D. Ordinary whole life. Answer: D. Ordinary whole life. Ordinary whole life insurance is characterized by a guaranteed level death benefit, guaranteed cash value accumulation that grows at a fixed rate, and level premiums payable throughout the insured's entire life, typically until age 100 or prior death. This structure provides lifelong coverage with predictable costs and guaranteed growth, making it a stable option for long-term financial planning. Term life offers temporary coverage, while universal and variable life policies offer more flexibility but with less guaranteed cash value growth or more investment risk, respectively. Question 24. A North Carolina agent is engaged in rebating. Which of the following best describes this illegal practice? A. Misrepresenting the terms of an insurance policy to a client. B. Charging different premiums for individuals in the same risk class. C. Offering a client a portion of the commission or something of value not specified in the policy as an inducement to buy. D. Making false statements about a competitor's financial condition. Answer: C. Offering a client a portion of the commission or something of value not specified in the policy as an inducement to buy. Rebating is an illegal practice where an agent offers something of value not specified in the insurance contract as an inducement to purchase a policy. This could include a portion of the agent's commission, a gift, or special favors. North Carolina law prohibits rebating because it creates unfair discrimination among policyholders and can disrupt market competition. The premium and policy terms must be the sole factors influencing a purchase. Question 25. An individual covered by a group life insurance policy through their employer terminates employment. What option is typically available to them regarding their life insurance coverage? A. The coverage immediately ends with no further options. B. they can convert the group coverage to an individual whole life policy without evidence of insurability. C. They can transfer the group coverage to their new employer's plan automatically. D. They must purchase a new group policy within 30 days. Answer: B. They can convert the group coverage to an individual whole life policy without evidence of insurability. A common provision in group life insurance policies is the right to convert the coverage to an individual policy upon termination of employment or group eligibility. This conversion option usually allows the individual to purchase an individual whole life policy with the same insurer, for an amount up to the group coverage amount, without needing to provide evidence of insurability. This is a crucial benefit for employees, ensuring they can maintain life insurance protection even after leaving their job. The conversion typically must be exercised within a specific time frame, often 31 days, after group coverage ends.